They are lying to you. They are looking you straight in the eye through the lenses of their high-definition cameras on CNBC and Bloomberg, and they are lying. It is Sunday evening, the 12th of January 2026. The world has shifted beneath our feet. And yet, if you look at the mainstream ticker parade, you would think it is business as usual. You see green arrows on tech stocks. You see talking heads discussing resilience and soft landings. You see the artificial tranquility of a system that is terrified of its own shadow. But I am sitting here, looking at data that I have not seen in 12 years of tracking this market. I am looking at a fracture in reality. While you were watching football this weekend, while you were distracted by the bread and circuses, the United States Department of Justice launched a criminal investigation into the most powerful man in the global financial system. Jerome Powell, the chairman of the Federal Reserve. This is not a drill. This is not a procedural review. This is the Pandora's box that they promised would never be opened. And the market, the real market, not the paper casino, has reacted with violence. As I speak to you right now, the physical silver market has effectively declared independence from the paper exchange. The spot price on your screen says $85.55. But try to buy an American Silver Eagle for that price. Go ahead. Try, you cannot. The real price, the price to put metal in your hand, is $100. The ghost price is $85. The crisis price is $100. The Federal Reserve is under siege, and the silver market just called their bluff. In the next hour, I am going to walk you through exactly what is happening, why the media is terrified to report it, and why this $100 silver coin is the tombstone of the old financial world. Let's start with the catalyst. For decades, the stability of the Western financial system has rested on one single, fragile pillar: the independence of the Federal Reserve. We are told, from the moment we take Econ 101, that the Fed is above politics. We are told they are the technocratic guardians of the currency, immune to the whims of Washington, immune to corruption, steady hands on the wheel. That myth died this weekend. The Department of Justice is investigating Jerome Powell over his 2024 congressional testimony and specific office renovation expenditures that raised red flags. Now, the media is trying to spin this. They are framing it as a minor ethical lapse, a bureaucratic slap on the wrist. They want you to believe this is a nothing burger. Do not fall for it. You do not launch a criminal probe into the chairman of the Federal Reserve unless you intend to break the institution. This is a civil war within the American state. It is the executive branch turning on the monetary branch. And the moment that investigation went public, the implicit guarantee of the dollar, the full faith and credit, was questioned. If the chairman of the Fed can be targeted, then the Fed is not independent. If the Fed is not independent, then the dollar is just a political token. And if the dollar is a political token, then where do you hide your wealth? The market answered that question in less than 48 hours. The answer is hard assets. The answer is anything that cannot be printed, subpoenaed, or debased. Let's look at the numbers, because math does not have a political agenda. Gold has hit a new all-time high of $4,610.54. That alone should be headline news everywhere. But the real story, the dangerous story, is silver. Silver spot closed at $85.55, up over 7% in a single session. That is a massive move. In any normal year, a 7% day for silver would be the event of the month. But we are not in a normal year. While the spot price, the paper price derived from futures contracts on the COMEX, was sitting at $85, I checked the inventory of every major dealer in the United States. APMEX, JM Bullion, SD Bullion, every single one of them had moved their brilliant uncirculated American Silver Eagles to $100 or higher. Some were at $102, some at $105. The smaller regional dealers were pricing even higher because they were scrambling to restock from wholesalers who were already empty. Look at that gap. The paper price says 85. The physical price says 100. That is a 17.5% premium. In a functioning market, premiums on Silver Eagles run about $3 to $5 over spot. Maybe $8 if supply is tight. But 17.5%. That is not a premium. That is a divorce. That is the physical market telling the paper market, you are irrelevant. This is what I call the premium gap. It is the spread between the illusion and the reality. The spot price is a ghost. It is a number on a screen generated by high-frequency trading algorithms and paper contracts. That will never be delivered. It is the price of a concert ticket on a sold-out website. It says $85, but you can't buy it. The real price is what the scalper outside the stadium wants. And right now, the scalper wants $100. Why is this happening? Because of a mechanism most investors are too blind to see. The paper market is suppressed by institutional players who have a vested interest in keeping the price low to protect their short positions. But the physical market is in pure price discovery. It is finding the clearing price where actual human beings are willing to part with their metal, and that price is soaring because trust has evaporated. But there is something darker driving this, something that explains why the dealers are panicked. There is a rumor circulating on the institutional desks in London and New York. I have heard it from two separate sources, at firms you would recognize. The rumor is that a major vault within the London Bullion Market Association, LBMA, is facing a delivery default. The chatter is that a massive player, likely a sovereign wealth fund or a central bank from the East, put in a massive order for physical silver delivery. Not paper exposure. They wanted the bars. They wanted the metal on a pallet, on a truck, in their possession, and the vault couldn't deliver. They didn't have it. They had sold paper claims on metal they didn't own. This is the fractional reserve dirty secret of the precious metals market. For every ounce of physical silver in the vaults, there are hundreds of paper ounces traded. It works fine as long as nobody asks for the real thing. But when confidence breaks, when the DOJ investigates the Fed, everyone rushes for the exit at once. They all want their metal, and the vault is empty. If this rumor is even partially true, we are not looking at a $100 ceiling. We are looking at a liquidity black hole. When institutions realize they cannot get metal at the paper price, they bypass the exchange and go directly to the physical market. They start bidding against Apple, against Tesla, against the solar industry, and against you. This is why we are seeing what I call the stress test scenario. In a conservative model, the premium gap stabilizes. But if the LBMA fails to deliver, if we see a formal default or a force majeure declaration, the premium could blow out to 50%. Do the math. A 50% premium on a $100 spot price puts the physical coin in your hand at $150. You would be watching CNBC tell you silver is $100, while your local coin shop charges you $150. That is the future we are staring at. We have to zoom out. This isn't just about Jerome Powell's office expenses. That is just the spark. The fuel is a geopolitical economic war that has been raging silently for a decade. Who has been buying gold and silver? Who has been draining the COMEX and the LBMA for years? It is not the American retail investor. It is the East. It is China. It is Russia. It is the BRICS nations. They have been preparing for this moment. They knew that the US dollar's weaponization would eventually lead to a crisis of confidence. By accumulating physical reserves, they have effectively cornered the West. Think about the timing. The DOJ investigation signals internal chaos in the U.S. government. It signals weakness. If you are a strategic adversary of the United States, this is your moment to strike. You don't strike with missiles. You strike with buy orders. You drain the physical inventory of the strategic metals needed for the U.S. economy. Silver for electronics, silver for solar, silver for missiles. By forcing the price of physical silver up, they are importing inflation into the United States. They are devaluing the dollar in real terms. The resilience of the DXY, the dollar index, is a mirage. It looks strong against the euro and the yen because those currencies are also dying. But against stuff, against gold, silver, oil, food, the dollar is crashing. This is a liquidity black hole event. Money is fleeing risk assets. It is fleeing the system that depends on trust. It is moving into the only assets that have no counterparty risk. If you hold a silver coin, you don't need Jerome Powell to be honest. You don't need the DOJ to be fair. You don't need the LBMA to be solvent. You just hold the metal. That is the premium you are paying for. You are paying for independence. Now, I want to give you a warning. Do not think this will be a straight line to the moon. The empire will not go down without a fight. The financial establishment has a playbook for this exact scenario. We saw it in 1980 with the Hunt brothers. When Nelson Bunker Hunt and William Herbert Hunt tried to corner the silver market, sending it to $50, the establishment panicked. The COMEX and the Chicago Board of Trade didn't just watch it happen. They changed the rules. They banned new buy orders. They hiked margin requirements. They forced liquidation. They crashed the price from $50 to $11 in weeks. They are going to try to do it again, mark my words. In the next week or two, you will see the COMEX announce a margin hike. They will raise the amount of cash required to hold a silver futures contract. This is designed to shake out the leveraged speculators, the weak hands. When they do this, the paper price, the spot price, will dip. You will see it drop to $80, maybe $75. The financial media will scream the silver bubble has burst. They will tell you it's over. They will mock you for buying at the top. But here is the difference between 1980 and 2026. In 1980, they were fighting two brothers. Today, they are fighting a decentralized, global swarm of sovereign wealth funds, central banks, and millions of retail investors who have lost faith in the system. You can bankrupt the Hunt brothers. You cannot bankrupt the People's Bank of China. You cannot bankrupt a global population that simply refuses to sell. So when the paper price drops on the margin hike, watch the physical price. If spot goes to $75, but the dealer still charges $100, then the intervention has failed. That is the signal. That is the moment the decoupling becomes permanent. We are standing on the precipice of a new financial order. The days of buying American silver eagles for $25 or $30 are gone. They are history. You will tell your grandchildren about them the way your grandfather told you about buying a candy bar for a nickel. The $100 floor is here. It is sticky. Even if the spot price dips, the physical price will not go back to the old world. The trust is broken. You cannot glue a shattered mirror back together and expect it to reflect the same reality. The DOJ opened Pandora's box. They thought they could target a man without destroying the institution. They were wrong. They have revealed the rot at the core of the system, and the silver market, in its brutal, honest, chaotic way, is the only thing telling you the truth. The screen is a lie. The coin is the truth. Things are moving fast. The landscape is shifting every hour. The institutions are positioning themselves. The retail wave hasn't even fully started yet. Wait until the average person realizes their bank account is losing value every second. Then the stampede begins. You are early. You are ahead of the curve. But being early is only useful if you act. Hold the core. Trade the edges. Ignore the noise. And remember, if you don't hold it, you don't own it. Good luck. You're going to need it. While the world was distracted by the daily noise of political theater and fluctuating interest rates, the tectonic plates of the global financial order just shifted violently in the dead of night. On January 3, 2026, a heavy cargo plane canned from Caracas, Venezuela. It had no flight plan. Its transponder was deactivated the moment it reached international airspace. But high-altitude tracking and intelligence leaks have revealed a truth the mainstream media is too afraid to touch. 200 tons of physical silver and gold were moved directly into the vaults of Beijing. This wasn't a standard trade. This was a strategic evacuation of national wealth as the United States prepares for what many call an imminent intervention. The Venezuelan leadership didn't look to the banks or the digital markets. They turned to the only thing that retains value when the bombs start falling and the sanctions hit 100%. Hard, physical metal. This secret flight is the smoking gun of a new era. An era where the US dollar is no longer the ultimate authority, and where the great silver exit is being led by sovereign nations fleeing a failing system. To understand the magnitude of this event, we must look at the mechanics of the ghost flight. For years, the West has utilized the weaponized dollar to isolate nations that do not align with its geopolitical interests. Venezuela, long the target of these financial strikes, has finally reached a breaking point. Reports indicate that Nicolas Maduro, anticipating a total freeze of Western-held assets, decided to liquidate the nation's remaining strategic stockpile of silver and gold. This mirrors a pattern we saw in 2019 when gold was moved to Russia and Turkey to bypass sanctions. But this time, the focus shifted to silver, the indispensable metal of the modern age. The aircraft took a dark route, bypassing NATO-monitored corridors and refueling in friendly African territories before landing in China. This was a direct barter. 200 tons of bullion in exchange for Chinese technology, advanced surveillance systems, and a promise of political protection. Not a single US dollar was used as a middleman. No SWIFT message was sent. No New York bank took a fee. This flight was the first live test of a parallel global economy, where the New York banking system is entirely irrelevant. A. The silver deficit and the Chinese hunger. Why silver? To the average retail investor, silver is just a volatile metal. To the Chinese Communist Party, silver is the fuel of their industrial dominance. China currently produces 80% of the world's solar panels. With the global transition to high-efficiency N-type solar cells, the demand for silver has reached a fever pitch. By accepting 200 tons of silver from a desperate Venezuela, China isn't just helping an ally. They are front-running a global shortage. They are acquiring a strategic resource at a massive discount, ensuring that while the West struggles with supply chain delays, the Chinese industrial machine remains lubricated with physical metal. B. The military-industrial implication. This is where the story turns from a financial thriller into a matter of national security. The Pentagon is currently facing a silent crisis. Modern warfare is built on silver. From the guidance systems of Tomahawk missiles to the advanced radar arrays of the F-35, silver's electrical conductivity is irreplaceable. Currently, the U.S. is nearly 80% dependent on silver imports. Every ounce of metal that China pulls into its vaults is an ounce that Raytheon, Lockheed Martin, and Northrop Grumman cannot access. By facilitating this ghost flight, China has effectively conducted a strategic strike on the U.S. military supply chain without firing a single shot. In a future conflict, the U.S. might have the printing press to fund a war, but China will have the raw materials to build the weapons. See the death of trust and the LBMA precedent. The move by Venezuela is also a direct reaction to the loss of trust in Western custodianship. In recent years, the Bank of England famously refused to return Venezuela's gold stored in London. That event sent a shockwave through every central bank in the world. The message was clear. Your gold is only yours if the West agrees with your politics. Maduro's decision to move his silver to Beijing is a signal that nations are no longer willing to risk their wealth in London or New York. We are about to see a wave of repatriation requests. If several nations demand their physical metal back at once, the LBMA and COMEX vaults, already at historic lows, will likely be found empty. D. The broken mirror, paper versus physical. The most shocking aspect of this 200-ton movement is that the spot price on the COMEX barely reacted. This is the ultimate proof that the silver market is fractured. We have a paper market where banks trade digital receipts to suppress the price, and a physical market where sovereign nations are moving hundreds of tons in the middle of the night. Strategic players are ignoring the screen price. They are looking at the inventory. When the physical metal is gone, the paper market will simply cease to function. The iceberg order of global demand is finally becoming visible, and the tip of that iceberg is pointing directly at a massive price explosion for anyone holding the physical asset. E. The formation of the commodity axis. We are witnessing the birth of a new financial alliance. Russia, China, Iran, and Venezuela are pooling their resources to create a real money standard. Last month, Ghana used gold to buy oil. Today, Venezuela uses silver to buy technology. Tomorrow, it will be Saudi Arabia. The exorbitant privilege of the US dollar relied on the fact that all commodities were priced in greenbacks. That world is ending. The flight from Caracas proves that a new barter-based, metal-backed system is already operational. This is the monetary reset happening in real time, ton by ton. The ghost flight of 2026 is a microcosm of the global economy's future. The West is left with the paper, the debt, the derivatives, and the rhetoric, while the East is securing the physical wealth. For the people of Venezuela, this is a tragedy. The final looting of their national heritage to keep a regime alive. But for the rest of the world, it is a warning. If a sovereign leader, with access to global intelligence, decides that physical silver in a Chinese vault is safer than dollars in a bank, you must ask yourself, what do they know that you don't? The era of digital promises is being replaced by the era of hard assets. Possession is no longer just 9/10 of the law. In a world of sanctions and freezes, possession is the only law. As the U.S. watches its influence fly away on an unmarked cargo plane, the question remains, are you prepared for a world where the dollar is just another piece of paper? The plane has landed. The silver is gone. The gates of the old system are closing. Secure your position before the transponders go dark on the entire global economy. Is this the final nail in the coffin for the petrodollar, or can the U.S. reclaim its dominance through force? Share your thoughts in the comments below. We are watching the skies so you don't have to. Friday, January 9th, 2026. This is a date that history books might one day record as the moment the illusion of market stability finally shattered. While retail investors were distracted by New Year headlines, a $14 billion trapdoor was quietly pulled open beneath the precious metals market. We aren't talking about a rumor or a speculative dip. We are talking about a mandatory contractual execution. Institutional banks are being forced to dump massive positions in gold and silver within a brutal 5-day window. If you've been watching silver hover near $80 and wondered why it hasn't rocketed to $100 despite the global chaos, you are looking at the reason. Tonight, we analyze the Bloomberg Commodity Index rebalancing, a technical mechanism being used as a weapon of mass liquidation. Is this a collapse, or is it the ultimate shakeout before the greatest wealth transfer in modern history? We are stripping away the propaganda to show you exactly how the smart money is positioning itself while the public is being led to the slaughter. To understand the magnitude of this event, we have to look at the mechanics of the BCOM, the Bloomberg Commodity Index. This isn't about sentiment, it's about math. Because silver and gold performed so exceptionally well throughout 2025, these deep, massive index funds now find themselves overweight. The rules are cold and inflexible. By contract, they must rebalance. They aren't selling because they think silver is overvalued. They are selling because their bylaws demand it. The numbers are staggering. We are witnessing the forced sale of $7.1 billion in silver and $7 billion in gold. This represents approximately 17% of the entire open interest in the March silver futures contracts. To put that in perspective, imagine trying to force nearly 1/5 of all active trading volume through a single exit door in just 5 trading sessions. Scotiabank's internal analysis, which has been circulating among institutional desks, confirms the pressure. This is what we call structural selling. It doesn't care about support levels, it doesn't care about your stop losses, and it doesn't care about the news. It is a mathematical sledgehammer hitting the market at precisely the moment when physical supply has never been tighter. The fiction of the spot price. The most critical thing for any investor to understand right now is the total divergence between the paper market and the physical market. When you see silver quoted at $78 an ounce on your screen, you are looking at a digital derivative, a promise that may never be fulfilled. In the physical world, the story is a nightmare for the bears. Major bullion dealers across North America are already reporting empty shelves. 100-ounce bars that used to ship in 48 hours are now on pre-sale for mid-February. Premiums have exploded to nearly 10% above the spot price. What happens when $14 billion of paper selling hits the market this Friday? The spot price might drop to $70, but the physical price will likely stay at $80 or higher as dealers hike premiums to manage their vanishing inventory. We are seeing a decoupling where the digital price becomes a fiction used to scare retail traders, while the physical metal becomes a trophy for those who can afford the gate fee. Geopolitical fuel on the fire. This liquidation isn't happening in a vacuum. On January 8th, the U.S. Coast Guard seized a Russian-flagged oil tanker. Iran is issuing warnings of preemptive strikes. The rules-based order is effectively dead. When major powers begin seizing assets on the high seas, the demand for non-sovereign stores of value, assets that cannot be frozen or canceled by a central bank, becomes insatiable. Silver and gold are the only assets that exist outside this weaponized financial system. Look at the oil-to-silver ratio. Crude oil is trading at $56 a barrel, while silver is at $78. It is historically rare for an ounce of silver to cost more than a barrel of oil. This anomaly tells us one of two things. Either oil is about to skyrocket due to Middle Eastern conflict, or silver is pricing in a total monetary collapse. In both scenarios, the paper sell-off on Friday is nothing more than a temporary distraction from a systemic fire. The empire of debt, the U.S. national debt, has crossed $38.5 trillion. The engine of the American economy is stalling, with job openings at their lowest level in a year. The Federal Reserve is trapped. They can either raise rates and bankrupt the government, or they can print money to monetize the debt. History shows they always choose the printing press. With Jerome Powell's term ending in May 2026, the administration is already vetting doves who will subordinate inflation concerns to keep the debt-fueled machine running. Silver at $78 is actually cheap when you adjust for the M2 money supply growth. If silver were to match its 1,980 inflation-adjusted peak, it wouldn't be $80, it would be over $700, while Wall Street trades paper contracts. The industrial world is facing a physical deficit that cannot be rebalanced away. Silver demand for solar panels and AI data center infrastructure is inelastic. You cannot build a high-speed processor or a high-efficiency solar grid without silver. There are no substitutes, even in a recession. These are political and technological mandates that transcend economic cycles. China understands this. While Western institutions are dumping paper silver to satisfy index requirements, Eastern powers are quietly absorbing every physical ounce they can find. They aren't looking at the 5-day chart. They are looking at the 50-year resource war. By allowing the paper price to be suppressed this Friday, the U.S. is essentially subsidizing the industrial rise of its greatest rivals. For the chartists among us, the noise of this Friday's liquidation should not obscure the signal of the 40-year breakout. Silver has spent 4 decades forming a massive cup-and-handle pattern. It broke the $50 resistance in 2024 and never looked back. In technical analysis, the longer the base, the higher the space. A 40-year consolidation doesn't end with a move to $80, it ends with a move that adds zeros to the price tag. We saw silver consolidate at $50 before jumping to $83. We are now seeing another consolidation. This Friday's BCom rebalancing is a false break or a shakeout, a move designed to trigger algorithmic selling and flush out leverage before the next leg higher. The gold-to-silver ratio has already dropped from 1:0 to 1 down to 6:0 to 1. If this ratio returns to its historical average of 1:5 to 1, silver has exponentially more room to run than any other asset class. Friday is not a crisis for the long-term holder. It is a clearance sale. The question you have to ask yourself isn't whether silver will go down this Friday. It very well might. The question is, if the price drops but you can't actually buy any physical metal at that price, did the price really go down? We are entering a phase where the spot price is becoming a hallucination. The $4 billion paper liquidation is the smart money trying to trick you into trading your physical ounces for their depreciating dollars, precisely at the moment those dollars are losing their last bit of international credibility. Successful investors in this environment are not trading price movements. They are accumulating ounces. They understand that in a system saturated with $38 trillion of debt and escalating global warfare, the only thing that matters is what you can hold in your hand. Don't let a 5-day technical event blind you to a 5-decade structural shift. The clock is ticking toward Friday. The paper will be dumped, the algorithms will fire, and the media will scream crash. But for those who can see through the smoke, Friday is the warning shot before the real explosion. Are you holding the asset or are you holding the promise? Choose wisely, because by next week, the exit may be closed forever. What is your move for this Friday? Are you buying the dip, or are you watching from the sidelines as the physical market disappears? Let us know in the comments below. We'll be watching the tape. Stay sharp, stay informed, and we will see you on the other side of the liquidation.